Warren Buffett is a name synonymous with investing wisdom. Known for his sharp acumen in picking companies with durable competitive advantages, Buffett has built a reputation as one of the most successful investors of all time. However, his investment prowess isn't limited to just companies and stocks. In fact, Buffett has made a few key non-stock investments that have been highly instructive, providing valuable lessons that extend beyond the stock market. In this article, we'll delve into two such investments, both of which arose during times of market distress, and explore the important takeaways Buffett has shared from these experiences. The first investment, a lesson from the farm. The first investment took place during the 1980s, a period marked by economic volatility in the American Midwest. During this time, the region experienced a significant downturn in farm prices, leading to what is often referred to as the farm price bubble burst. While many saw this as a period of uncertainty and risk, Buffett saw an opportunity. In his 2014 letter to Berkshire Hathaway shareholders, Buffett recounted the story. In 1986, I purchased a 400-acre farm located 50 miles north of Omaha from the FDIC. It cost me $280,000, considerably less than what a failed bank had lent against the farm a few years earlier. Buffett's purchase was not driven by a deep understanding of farming. On the contrary, he admitted that he knew nothing about operating a farm. This humility, however, did not deter him. Buffett's son, who had a passion for farming, helped him get up to speed on the basics of farm management, including the farm's production of corn and soybeans and its operating expenses. Analyzing the investment. Despite his initial lack of knowledge, Buffett approached the farm investment as he would any other, by analyzing its potential for returns. He estimated that the normalized return from the farm would be approximately 10%. This estimate was based on a simple yet effective analysis of the farm's productivity and the prices of the crops it produced. Buffett also believed that two key factors would work in his favor: increased productivity over time and a rise in crop prices. His analysis led him to conclude that the investment had minimal downside risk and a substantial potential upside. Reflecting on the decision, he noted, "I needed no unusual knowledge or intelligence to conclude that the investment had no downside and potentially had substantial upside." Long-term success. Buffett's decision to invest in the farm turned out to be a resounding success. By 2014, the farm had tripled its earnings and was valued at 5 times the amount Buffett had originally paid. This outcome was a testament to Buffett's ability to identify value in assets that others may overlook, as well as his willingness to make long-term investments based on sound analysis and patience. The second investment, seizing opportunity in real estate. The second non-stock investment that Buffett highlights also emerged from the aftermath of a burst bubble, this time in commercial real estate. The early 1990s were a turbulent period for real estate markets, particularly in New York City. Overly optimistic lending practices had led to the collapse of many savings institutions, resulting in a glut of distressed properties on the market. One such property caught Buffett's attention in 1993. It was a retail space located adjacent to New York University, NYU, a prime location by any measure. The property was being sold by the Resolution Trust Corporation, RTC, an entity created to manage and sell the assets of failed savings institutions. Buffett's analysis of the property. Buffett's approach to analyzing this real estate opportunity was methodical and thorough. He determined that the unleveraged current yield from the property was approximately 10%, a promising figure that suggested the property was undervalued. One of the key factors that made this investment attractive to Buffett was the property's potential for increased income. The RTC had, in Buffett's words, undermanaged the property, leaving several stores vacant. He realized that leasing these vacant spaces would significantly boost the property's income. However, the most compelling aspect of the investment was the opportunity presented by the lease terms of the property's largest tenant, who occupied about 20% of the space. This tenant was paying rent of only $5 per square foot, while other tenants in the area were paying an average of $70 per square foot. The bargain lease was set to expire in 9 years, providing a clear pathway to substantially higher earnings. Buffett also recognized the enduring value of the property's location. NYU was a well-established institution, and as Buffett astutely observed, NYU wasn't going anywhere. The outcome of the investment. With this analysis in hand, Buffett decided to invest in the property, joining a small group of investors to make the purchase. The decision proved to be highly successful. By 2014, Buffett reported that annual distributions from the property exceeded 35% of the original equity investment. Moreover, the property's mortgage had been refinanced twice, in 1996 and 1999, allowing the investors to receive special distributions totaling more than 150% of their original investment. This success underscored Buffett's ability to identify and capitalize on opportunities that others might overlook, particularly in distressed markets. Key lessons from Buffett's non-stock investments. Buffett's experiences with these two investments provide several important lessons that are applicable not only to investing, but also to decision-making in general. The importance of timing. One of the most striking aspects of both investments is the timing. Buffett made these investments after bubbles had burst, when prices had fallen and the assets were available at a discount. This contrarian approach is a hallmark of Buffett's investment strategy. Instead of following the crowd and buying at the peak of the market, Buffett waits for opportunities to arise when others are selling in panic. This patience and discipline are crucial for achieving long-term investment success. Focus on future productivity. Buffett emphasizes the importance of focusing on the future productivity of the asset you are considering. Whether it's a farm or a piece of real estate, the key question is, how much income will this asset generate in the future? If you can't make a reasonable estimate of the asset's future earnings, Buffett advises, just forget it and move on. This principle is central to Buffett's investment philosophy. He looks for assets that have clear and predictable income streams. In the case of the farm, future productivity was tied to the yield of corn and soybeans and their anticipated prices. For the retail property, it was the rent per square foot and the potential for leasing vacant spaces. So simplify your investment decisions. Another lesson from Buffett's non-stock investments is the value of simplicity. Buffett is known for avoiding complex investments that require specialized knowledge or expertise. Instead, he focuses on opportunities that are straightforward and easy to understand. As Buffett himself noted regarding the farm investment, I needed no unusual knowledge or intelligence to conclude that the investment had no downside and potentially had substantial upside. This approach not only makes investing more accessible, but also reduces the risk of making costly mistakes. Patience pays off. Both of these investments highlight the importance of patience in investing. Buffett didn't expect immediate returns. Instead, he was willing to wait for the investments to mature and deliver long-term value. This patience is a key component of Buffett's success and a reminder that good investments often take time to pay off. 5. Leverage market inefficiencies. Buffett's ability to spot inefficiencies in the market played a critical role in both investments. In the case of the farm, the inefficiency was the farm's undervaluation due to the burst bubble in farm prices. For the retail property, it was the undermanagement by the RTC and the below-market rent paid by the largest tenant. Buffett's strategy involves identifying these inefficiencies and taking advantage of them before the rest of the market catches on. This ability to see value where others don't is what sets great investors apart from the rest. 6. You don't have to be an expert in everything. Buffett's admission that he knew nothing about farming when he bought the farm is an important lesson for all investors. You don't need to be an expert in every field to make smart investments. Instead, you can rely on others who have the necessary expertise or simply focus on the fundamentals that are easy to understand. 7. Opportunities exist beyond the stock market. Buffett's non-stock investments demonstrate that valuable opportunities exist outside of the stock market. Real estate, farmland, and other tangible assets can provide solid returns and serve as a hedge against market volatility. These investments also offer diversification, reducing the risk associated with a portfolio heavily weighted in stocks. Applying Buffett's lessons to your own investments. While it's unlikely that most investors will have the opportunity to buy a 400-acre farm or a prime retail property in New York City, the principles that guided Buffett's decisions are widely applicable. Here's how you can apply these lessons to your own investment strategy. 1. Look for undervalued assets. Like Buffett, keep an eye out for assets that are undervalued due to temporary market conditions. This could be a stock, a piece of real estate, or even a business that others have overlooked. The key is to buy when prices are low and to hold on until the true value is realized. 2. Focus on future income. Before making any investment, consider its potential to generate future income. Whether you're investing in stocks, real estate, or another asset class, your decision should be based on the asset's ability to produce a reliable and growing income stream. 3. Invest in what you understand. Buffett's success comes from investing in assets he understands or can easily learn about. Avoid overly complex investments that require specialized knowledge. Instead, focus on opportunities that are straightforward and within your area of expertise. 4. Be patient. Good investments often take time to deliver returns. Don't be discouraged by short-term fluctuations or a lack of immediate profits. Patience is key to achieving long-term investment success. Diversify your portfolio. Don't put all your eggs in one basket. Diversifying your investments across different asset classes, such as stocks, real estate, and farmland, can reduce risk and increase your chances of success. Today, it's easier than ever to diversify, thanks to investment vehicles like real estate investment trusts, REITs, and crowdfunding platforms. 6. Learn from the experts. Finally, learn from the success stories of experienced investors like Warren Buffett. Their insights and strategies can provide valuable guidance as you navigate your own investment journey. Modern opportunities in farmland and real estate. In today's investment landscape, you don't need to purchase an entire farm or a commercial property to gain exposure to these asset classes. Thanks to modern investment platforms, even small investors can participate in the potential rewards of farmland and real estate. Real estate investment trusts, REITs. REITs are companies that own, operate, or finance income-producing real estate. By investing in a REIT, you can gain exposure to a portfolio of real estate assets without the need to manage the properties yourself. Some REITs specialize in retail properties, while others focus on farmland or other types of real estate. This allows you to diversify your investments within the real estate sector. 2. Crowdfunding platforms. Crowdfunding platforms have revolutionized the way individuals can invest in real estate. These platforms pool funds from multiple investors to purchase institutional quality real estate assets. As an investor, you can earn rental income and share in the profits when the property is sold, all without the responsibilities of being a landlord. Conclusion. Warren Buffett's non-stock investments in farmland and real estate offer timeless lessons for investors of all levels. By focusing on undervalued assets, future productivity, and simple, understandable opportunities, Buffett has demonstrated that successful investing doesn't require extraordinary intelligence or specialized knowledge, just a disciplined approach and a willingness to act when opportunities arise. As you consider your own investment strategy, remember the wisdom of the Oracle of Omaha. Whether you're investing in stocks, real estate, or another asset class, the principles that guided Buffett's decisions can help you make smarter, more informed choices that lead to long-term success.